Are we live, Winston?
Yes, we are live, Tyler. We are live. A little bit of a snafu on scheduling, but we are live now. What's going on, man?
Nothing, man. Hanging out with underwrite this DeVito with you, and then go barbecue some steaks. What do you think about that?
I love the idea. I'm going to put my headphones in. So let's get
All right.
started. Let's get started with this DeVito.
Yeah. Let me share my screen here. So this DeVita is just outside, just actually in the Atlanta MSA. It's in Decatur, Georgia. Came on the market yesterday. What's today? 2 days ago, I think. So I've got, drop the pin there. You can see where that is. Just outside of Atlanta, in the Atlanta MSA. Decatur is also a county seat. So it's one of these kind of interesting little towns that's, borderline on a large city, a growing city. So definitely has high potential for growth there. I think we see a lot of these towns that get absorbed into MSAs around the country. So this is one of those. This asset in particular, just turn the screen over here. Is sitting just off a main retail road. It's pretty much all medical in this area. DeVita, you have a hospital here. You have a dental clinic here, a little bit north. This is a very medical area. And then, if you zoom out a little bit, you can see that it's surrounded by residential, right? So typical setup, kind of like not a real medical park, but it's situated in a medical area surrounded by retail in a fast growing area. You been to Decatur, Winston?
Decatur. You're not from Georgia.
Decatur, okay.
Are you,
Now I've never been to Georgia, so.
Well,
Decatur,
first
Decatur,
and foremost,
Decatur.
It pains me as a University of Tennessee University of Tennessee Vols fan to say this, but University of Georgia just won a national championship, and then they beat my Vols too during the regular season. But anyhow, congratulations to the Georgia Bulldogs that are actually in Athens, Georgia. I do not believe I've been to Decatur. I haven't, so I don't know this market personally. So I cannot speak too much about it. I do see that, Emory University has got something close to here. Emory is a great institution. It's a great university. So I would argue that, that area is going to be a nice area if Emory is got a large hospital there.
Yeah. Yeah, man. I think it's a great area. This building's been here. Well, I think it was built in 1997. It's an older building, but this lease is actually relatively new. It's a 15-year lease, and there's 10 years left on it. You can pop it open right now and start having a look at some of the lease details. So basically, as we were saying, right? So this is a DeVita lease. Came on market a couple of days ago. It's a 10,000 square foot building, and they're selling it at a 6 cap. So just a little bit about DeVita first. DeVita's a public company. They're a double B. They're a double B credit rated company. We'll look at that down below, what that means as far as discount rates and the cash flows. But they're a double B rated company. They started the lease in October 2018. Almost 5 years in, 10 years left on the lease. It's a borderline triple net lease. We can talk a little bit about that. It's kind of marketed as triple net lease, but there are certain things that they say are covered. Obviously, insurance, utilities, property taxes are obviously all covered. Most of the structural stuff is covered. Parts of the roof are covered, not all of it. So there are some landlord responsibilities. I don't know if you want to get into some of that, Winston, on these hybrid.
I do. Listen, the buzzword is triple net lease. As we've mentioned before, a lot of people use triple net very liberally, like, in the sense it's very broad. And so, it's very important to dig into the lease details. In this case, I would say it's at best a double net lease. Yes, It looks like there are kind of some split costs between the roof and structure between the landlord and the tenant. That's going to be because the building's older. If I was representing the Vita in that initial negotiation, which going into that building, I would say, listen, this building is older. It's not a brand new building. So the roof warranty is not the same. And the structure is older. You're not the first tenant, right? I'm actually going through that right now in a negotiation in Texas. So with a different medical office. So anyhow, that's why that's probably split. Again, that's speculation on my end, but this is not an absolute triple net lease. So just keep that in mind. Anytime there is landlord responsibility, it cannot be an absolute triple net lease. And then you go in and say, okay, absolute versus triple net. It's kind of semantics for me. There are landlord responsibilities that impacts the cap rate, period.
Yeah, exactly.
Also, something really important to point out, I'd mentioned Emory University. Decatur's right outside of Atlanta, Georgia, right? It's a suburb. So I've never been there, but I mean, Atlanta is Atlanta. Major metro area, a lot of growth. It's not going anywhere. So it's probably one of the larger markets that we've underwritten.
Yeah. So let's jump into it. Let's jump into the cash flows real quick. This property has about $270,000 a year in net operating income. They're asking about $4.5 million for it, so they're basically asking to sell it at a 6 cap. It is corporate guaranteed, so you do get those double B rated cash flows while the lease is in play. If we look at the acquisition cash flows, pretty standard procedure here. Add a little bit for closing fees, and you're in for just over $4.5 million. When you look at the operating cash flows, the way this lease is set up, so this lease has 10% bumps every 5 years, and it's just actually getting a bump this year. So you're going to have to wait this full 5 years for the next bump. It's just finishing the first 5-year period now, the first 5 years of a 15-year lease. And then those 10% bumps are in for every 5 years, including the 2 options that come at the end of the lease, which DaVita has. So DaVita has the option to hold this thing for the next 20 years. So, if you're planning on buying this through a redevelopment or something like that, this probably isn't the best property. You probably want to count on those cash flows for the next 10 years at least, and then, potentially another 5 to 10 years after that. If you look out to the right, you can just kind of see how those cash flows flow up into year 11. By the time you would end your lease, you'd be at $326,000 in net operating income. And I've put aside here, $10,000 a year for capital reserve, 10,000 square foot building. It's a bit of age in the building. Any comment on that, Winston? Too high, too low? You're muted, man.
Sorry, I was muted. The building's not very old, so I think you got to put the capital reserve in there. With what you have, I think is sufficient. A lot of banks like to put a percentage of the NOI down. So they'll put like 2 to 4%. I think that's a little too high. But again, banks, they're risk adverse. So I think you're fine. I think you're fine with that. You got to put something down because it's not absolute.
Would the banks be wanting 2 to 4% specifically for structural repairs, or would that also be like in case something happens with the lease, if it's a tenant that might not be AAA rated tenant or whatever?
My conversations with a lot of banks has just been they just like it for the what ifs, and that's kind of how they leave it. They said there's always something that the landlord has to pay for. Well, in an absolute triple net lease, they shouldn't. However, 10, 15 years down the road after the initial term is up, or if the tenant defaults, there may be some landlord responsibility there. So I think that's kind of what they're planning for.
Cool. Let's talk about disposition. So this lease is up in 10 years, so that's probably a good time to look at disposition options. In this case, we got 2 scenarios. One is the tenant renews and stays there, and you dispose of it at renewal. In that case, you're bringing in 320,000 plus a year in NOI at the time of disposal. I'm assuming an exit cap rate of 6.5. That would give you 5 basis points more per year for the next 10 years. Pretty reasonable, pretty conservative assumption. We can look at down below how the sensitivity on that looks. If it was 6.7, 6.3, whatever, you get a better idea of the range of returns you could get depending on what the exit cap rate looks like. And then down below we have an adaptive reuse. So we're in a medical park. I don't know, Winston, do you think there's any other use there other than medical for this building?
No, I don't. I think DeVita is actually a really good medical, and by say medical, I mean kind of your traditional physician-based or even behavioral type buildings. But they've typically got quite a bit of rooms and walls. So the best use is medical office for it, but bar none for a DeVita. The build out's not going to be super simple if you try to make it into like a restaurant or something like that. And given its location, kind of in a medical park, that's its natural redevelopment.
So we've got a 10,000 square foot building there, right? So in the case that you do need to adapt it to a new tenant, it could cost a bit of if in this scenario I'm putting $100 a square foot, 10,000 square foot building, it's not cheap. So you can see that in those two scenarios, even though you could probably exit at a better cap rate after an adaptive reuse, you're still looking at about a $4 million net proceeds versus the 4.7 if DeVita just sticks around. So in this case, I feel like there is a bit of a difference between the two scenarios. So it does matter what the percentage is, if DeVita goes away, if they don't stay.
Yeah.
I've assigned a 90% chance they stay, 10% chance they leave. You can play with those numbers. Winston, do you think that's reasonable?
I think it's good. I think it's a fair prediction.
Okay, so let's look at this real quick, right? So these are the unlevered cash flows. If you were to buy this thing today, you're in for $4.5 million. You'd make about 250, then you get your bump up to 280 a year, and then you're going to exit it at a weighted average of 5 million, right? That's going to give you, let me just make this 0. So this is now, it says leveraged. This is now unleveraged. That's going to give you a 6.24 unlevered IRR, right? So the IRR is somewhere around the cap rate, which is 6, and it's also somewhere around what your loan is going to be. So when you take a loan out on something, on a property like this, basically what you're doing is just accommodating how much money you have and how positive or negative you want the cash flows to be. Because the loan rate is a little bit higher than the IRR, you're going to see some negative cash flows in the beginning if you take out a large loan. So we can play with this. Right now I got this at 0% loan, max LTV. If you were to put 50% down and get a 50% loan, well, your cash flows become pretty flat. Your IRR does go down a little bit because your cost of the loan at 6.5% is higher than your unlevered IRR. But I mean, at the end of the day, it's going to depend on how much you want to put down, how much money you have to put down, and if you care about the positive or negative cash flows. If you were to go to say 90%, then you're having negative cash flows the entire time, and then you're just getting your money back at the end with the 1.5 million.
Yeah, and I mean, we can play with the number to fit any individual investor's particular situation, right? Like no one's going to go out and be able to even get a 90% loan to value today. So what we're seeing mostly right now is kind of that 50%. Some are getting away with kind of 35% range, but banks are wanting more and more of a down payment. So, and look, you're having to do that. If you're executing deals, if you're under the gun because of 1031 or any other deadlines you may or may not have, it may make sense to then therefore, do the deal that for tax purposes or whatever your individual situation is. But banks aren't going to do any better than a 70% today, and most banks aren't even doing that.
I mean, if we're looking at 50% right here, right? And the reason these cap rates are going up is because the cost of capital, or one of the reasons is that the cost of capital has gone up so much, right? So we're evaluating this on a loan with 6.5% interest per year. A year ago or whatever, these were, instead of 6.5, it was 3.5, and this deal looked way better, right? You had an 8.5, 8.3% levered return. Today, that levered return, just because your loan isn't as good, is down under 6%. So, there is pressure for these cap rates to come up because of this. So today, most of these triple net lease assets, at least up to this point, they've been going up in cap rates, but they haven't come up really enough yet in comparison to the rates, to the loan rates. The idea today is it's kind of hard to find a triple net lease asset where you have positive leverage. So the leverage you're going to use is really just to fit how much money you have to put down on the asset, rather than expecting to get additional returns on the leverage, unless you have a really high cap rate asset. But it's quite difficult to find those today. So what do you think? Do you think this asset at a 6.3% unlevered return is a good deal, Winston?
It always depends, Tyler. Look, I think today it is rightfully so that buyers are weary and want to kind of sit on the sidelines to understand what's going to happen next. If I'm in a situation where I have to deploy capital, and I am not in a negative cash flow situation, I don't believe in, it's just like me personally, I'm never going to advise a client to go into negative cash flow assets. Just not my style. It's not how I would advise someone. But for someone who has money that they need to place timely, I do believe this is a good asset. I think 6.3 or 6.5 is not bad on your money. I know that inflation has been higher than that, but that's out of our control right now in this environment. I think this is a solid tenant in a good market, in a good building, in a good location. It will be a medical office building probably for the foreseeable future. That's my belief. So I would pull the trigger if I'm in that situation. If I do not need to deploy capital in a timely fashion, and I do not have those constraints, those needs that I just mentioned, then I would not buy the property today. I would sit on my cash and wait.
Yeah, I agree 100%. I think it's a good property. It's a good tenant. I think the price is, well, we can see it right here. The price is reasonably in line with market. These are medical, so these are triple net lease medical office sales in the last 6 months. You can see the remaining term versus cap rate. The orange dot right here, this is this DaVita. So it's pretty much right on the regression line of what these assets have been trading at. Obviously, there's a lot of volatility here. You have 4.5 cap assets, you have 7.5 cap assets, but this DaVita is right in the middle of where it should be for the remaining term versus closing cap rate, what the market's been doing. And then if you look at the NPV, so I said earlier that DaVita was a double B corporate rated company, right? So double B corporate bonds are about 6.9% today. So if they're asking for a 6% cap rate on this asset, if you have to be in real estate, if this money that you have has to be in real estate, that seems like a reasonable cap rate based on comparable sales for medical assets that we've seen recently in the market. However, if this money is money that you can move around between asset classes, so between real estate, between debt or equity, or wherever you want to put it, you want to be comparing to corporate bonds. And the double B corporate bonds at 6.9% means that you should be discounting this asset, if you have the ability to take this money out of real estate, at 7% at least on the income cash flows, and then a higher discount on the disposition cash flows. If you do that, you get a purchase price of just over $4 million, which would be purchasing at a 6.7 cap, to put this investment in line with the investment opportunities that you have in corporate bonds. So just to put that into perspective, if you were to buy this DaVita at that, at that cap rate that I mentioned, now you're looking at a nearly 10% levered IRR. You actually do have positive leverage, and you're making about 10% levered IRR with a 70% loan to value. So for me, if you could get the asset at a price that's comparable to a comparable corporate bond, then it actually becomes a very attractive deal.
Yeah, that's a good point, Tyler. I'm glad you shared that. It's good. And just so everyone knows, we are tracking sales, and these analytics are primarily in the South and Southeast, right, Tyler? I mean, so
Yeah.
obviously we don't have the data for every sales transaction, but what is public, what is out there, we do track for the South and Southeast. We don't track, New York or California and those large markets. We stick to our area, which is the American South and Southeast.
Yep. Any more on DaVita?
No, I think DaVita, for those that may not know, is a dialysis clinic for primarily those that have needs that need dialysis. Some of those are what is it? I apologize, I'm having a blank here. Insulin, help me out. Diabetes. A lot of diabetes.
I've never used it. I've never used a DaVita.
Yeah, I haven't either, but a lot of people do. It's one of those things. It is a need. And look, they provide a need across the country. They're a global company, and it is corporate backed. So it's a strong company. They have their fair share of. They do have some legal kind of issues against them, but I don't think it's anything out of the ordinary. Not like some of the other companies that we've discussed in the past. So anyhow, strong tenant. Thank you, Tyler, for coming on today. I'll see you in a bit, man. Hopefully we can grill out and enjoy it.
For sure. All right. Cheers, man.
See ya. Bye.